I want to talk about capital investment decision making, in particular, the way in which organisations are going to assess the likely performance of their major capital expenditure items. These decisions are important because capital expenditure ties up a large amount of money for the organisation and is a driver of long-term performance. What we're going to be thinking about is the way in which organisations are going to use various techniques, and we'll be thinking about the pros and cons of using these techniques. We're thinking about capital budgeting, which is our capital investment decision analysis. We're thinking about how to use the money the funders of the organisation are providing. So we've got the capital investment that we're thinking about. It ties in with both the financial decisions and the financial effects, which is what we're trying to assess and forecast. It also has to tie in with the broader strategic decisions that the management are making. Another way of thinking about this is we have, on the one hand, we have the sources of capital for an organisation. So that could be either debt or equity that's provided by the external financiers. Internal financing could include the asset sales or just general operational cash flow. What we're focusing on here is going to be the way in which capital is used. So in particular, we're thinking about capital expenditures. It could also relate to investment, research and development. So that's really the focus of where we're going today. Typical sorts of investments decision. It should be a buy new equipment, should we replace equipment? How would we rank between various types of equipment, various types of services? Typically, an organisation is going to be doing one of two things. Capital budgeting or capital investment analysis is typically going to try and help managers answer a couple of sorts of questions. It could be, are we going to accept a proposal or does it not meet our investment criteria? It could be that we're going to try and use our information to rank various proposals or to select from two mutually exclusive proposals. The main differences between a number of our capital investment analysis decisions is going to be whether they take into account what's called the time value of money. So the time value of money reflects the fact that a dollar in the future is not worth the same as a dollar today. So that we would sooner have a dollar today than a dollar in the future. So two of the main ways that organisations are going to assess their capital investment decisions is going to be the net present value or NPV and the internal rate of return. These methods both take into account the time value of money. A third mechanism that we're going to have a look at, the payback period, doesn't. So it doesn't distinguish between the purchasing power of a dollar today or a dollar in the future. We know that people would prefer to receive a dollar today rather than a dollar in the future. That's because the purchasing power of a dollar today is higher than a dollar in the future, or they could use it to invest and generate a return on the money on the dollar today. So the time value of money technique reflects that. So we need to think about a way of working out what a dollar in the future is worth in terms of dollars today. And to do that, we need what's called the discount rate. So this is the heart of the net present value or NPV analysis. And really what we're thinking about, the discount rate is also called the hurdle rate or the opportunity cost of capital. So it's the rate at which, or the way in which we can convert dollars in the future back into dollars today, also called the opportunity cost of capital. And if we're thinking about how we'll go about doing a net present value or an NPV analysis, we need to do a number of things. We need to work out first, what are the relevant cash flows? We need to work out when those cash flows are going to occur so that we know the appropriate discounting period. We will then work out what the present value of each period's cash flows are. We'll then add all of those things up. That'll get us the total net present value of the cash flows. So this is an example that we've got from the slides, and I'll put a link to this spreadsheet in the notes in the description of the video. So what we've got here is we've got an initial investment of $10,000, which I've modeled as negative $10,000 because the initial investment is going to be a cash outflow. I've then got cash inflows that the investment will generate of $5,000, the second year $4,000, then $3,000, then $2,000, then $1,000. Note that I've got the initial investment in year 0. So that's kind of now. And in year 1 is kind of the first year of the cash inflows. So the first thing I'm going to do here is, I'm assuming in a world with no tax, I'm going to take my net cash flows. So just so I'll be consistent, I'm just going to add up row 8 and row 9 is all I'm going to be doing here. I then need the present value factor. So that's the factor that turns dollars in the future, that is our 5,000, 4,000, 3,000, 2,000 and 1,000, into dollars today. Now, here's the formula that I'm going to be using. My present value factor will be 1 divided by 1 plus R, where R is the discount rate, to the power of n, where n is the number of periods. In this case, it's going to be years. So in the first year, I'm going to be doing 1 divided by 1 plus discount rate, and I'm going to hard code that in by hitting F4. That way it won't copy across when I'm dragging the formula across. Then I'm going to the power of, which is typically going to be Shift 6 on your keyboard. Then I'm going to be clicking 0, and that'll give me 1. Now, that might look a little weird, but that's exactly what we want. The net present value of $1 today is in fact $1. And when we drag this present value formula along, we'll see that what this is telling us is that in 1 year's time, the value of $1 in 1 year is 91 cents. The value of $1 in 2 years is 83 cents, and then 75 cents, and so on. So the further we go out into the future, the less $1 is going to be worth in terms of dollars today. So what I can now do is I'll add all of these things up. So what I'm now going to do is I can get the net cash flow, which is multiplying net cash flow by the present value to get the present value of net cash flows. And again, I'm going to drag that formula across. And to get the NPV, I'm going to add everything up. And when I add everything up, I get 2,092. And what I can do is then I can see what the impact of changing the discount rate is. If the discount rate goes down, NPV goes up. Discount rate goes up, NPV goes down. So the higher the discount rate, the lower the NPV for the same set of cash flows. You might also note that Google Sheets, as well as Excel, has its built-in NPV calculator. So if I go NPV, and I'm going to hit tab, and I'm going to click 10% as my discount rate, and then I'm going to highlight the cash flows. And now when I hit enter, a weird thing happens. I'm expecting to get the 2,092, but I get 1,902. What's going on here? What's happening in both Google Sheets and in Excel is that the NPV formula assumes that the first number that we give it is in fact coming at the end of year 1 rather than that initial investment. So here's what I have to do to make it work with the formula. If I go NPV, I'm going to go back and get discount rate. Now I hit comma. Now I'm going to highlight the cash flows but leave out that initial investment. And what I'm now going to do is say, let's take the initial investment, and I'll add these two things together. There we get our $2,092. So that's what's going on here. So just be careful when you're using the built-in formula, because that built-in formula assumes that the first number that we give it occurs in a year's time, where typically what we're going to be finding is the first number that we're after is going to be occurring as our initial investment in what we'll call time 0. So that's the example we've been through there, 2092. So the decision rule that we typically take is if NPV is positive, we'll accept the decision. If NPV is negative, we're going to reject the proposal. Now, one of the difficulties that we have when we're using net present value techniques is in fact working out what the appropriate discount rate is, or the hurdle rate. Now, what finance theory tells us is that we should be using a rate that reflects the riskiness of the project that we're investing in. But organisations will typically use their own internal rates or hurdle rates. Often that's tied to the organisation's cost of capital or WACC. But strictly speaking, what we should be doing is assessing the project on the riskiness of the project rather than the riskiness of the firm. So I've got another example. Let's just go through another one. And here we can introduce a few extra assumptions. So we've got our initial investment, we've got our ongoing capital costs, operating costs, and we've got revenue that changes over time. Now we'll say that we're going to be able to recover the initial investment at the end of year 5. Again, we've got a discount rate. And once again, we can see how this looks on our spreadsheet. And again, this is the spreadsheet that I'll have linked in the numbers below. So the investment of 250,000, yearly operating costs, estimated revenue of 140, then increasing. We can see, again, I'll code this initial investment as a negative number. I'm then going to take the revenues each year, 140, 145, 150, 160, 165. Note that I've got up here in cell G13, I've got that $20,000, which is the salvage value of our equipment. The expenses that we have starting in year 1 each year is $50,000. That will give me my net cash flow, and I'm going to get that by taking just the sum of B13, B14, and I'll subtract B15. So your choices when you're setting up your spreadsheet is that you could either code these expenses as negative numbers, or you could code them as positive and just remember to subtract them. So as long as you're being internally consistent. So what we end up with here, so we end up with our net cash flows, 250, 90, 95, and so on. And again, we're using this same formula to get our present value factor. So it's the 1 divided by 1 plus r to the power of n. So n's the number of periods that we have. Again, we get the present value factors, and we multiply each year the net cash flows by the present value to get the present value of each of our periods' net cash flows. We then add all of those up, and we end up with our net present value of 144,000. So if that was the only decision that we'd be taking, then we'd be accepting this proposal. Now what we're going to do, now let's assume that tax comes into play. We need to be careful about what's happening with the tax, because what we're interested in for our NPV analysis is the impact on cash flows. So depreciation is not a cash flow, but for an accountant, what the depreciation does is allocate the cost of the investment over its expected lifespan. Depreciation will have cash flow impacts on tax and the amount of tax that's paid. And so that's what we're going to be modeling. So revenues won't change, so the investment won't change. Negative 250, we're still going to get residual value of 20,000. Revenues are the same, expenses are going to be the same. So to work out how much tax I'm going to pay, I've got my tax calculation kind of down below, because I'm trying to keep that away from the actual cash flows. So I'll often recommend just doing the tax analysis in a separate part of your spreadsheet to the actual NPV calculation. So what do we have going on for tax purposes? We've got the revenue, which will be assessable for tax purposes. We'll have the expenses, which are going to be deductible for tax purposes. The next row that we've got is depreciation. So depreciation, I'm going to be depreciating the equipment over 5 years. So we can see that the formula that I'm using is B3, and if I go back up to B3, that's going to be the investment, and I'm dividing that by 5 because we're depreciating that initial $250,000, and that initial $250,000 is the initial capital cost that we've got here. Let's work through this example. We've got an initial investment of $250,000. We've got our annual operating costs of $50,000. We've got the revenue that the investment's going to generate of $140,000, which increases over time. At the end of the 5-year period, we're able to sell the equipment for $20,000. So that'll impact that year 5 cash flow. The discount rate's 10%, and we're still assuming the tax rate's 30%. So in a no tax world, we can model this as we've got the negative $250 investment, and remembering the residual value goes into our year 5 cash flows. Our revenues, 140 through to 165. The cash expenses are 50,000 each year. So we end up with our net cash flow. We're just going to take into account the investment, subtract the expenses. We'll get 90, 95, 100, 110, and 135 as our net cash flows. Again, same principle for generating our NPV factors. It's 1 divided by 1 plus the discount rate, which is cell B6. Make sure that's in brackets. And then we're going to raise that to the power of whatever number of periods we've got. So in the first year, it's 0, then 1, then 2, then 3, and so on. That gets our present value factor. Each year, we're going to be multiplying those cash flows by the present value factor to get the present value of the cash flows. We're then going to add those up, and we get the NPV. We get the NPV of 144,400. If we're introducing tax, then the tax is going to be, assuming that we're going to be paying, if we're allowed to depreciate our asset over 5 years. Let me just pop the 5 years in here so that that's clear. If tax allows us to depreciate our asset over 5 years, then we need to incorporate the actual cash flow impacts of the tax that we're going to be paying. So I'll put tax calculation. I like to keep the tax calculation separate from the actual NPV calculation, just to keep things clear. So the line item that we're calculating here is what's the tax that we're going to be paying in each year. So the investment's the same, the revenues are the same, the cash expenses are the same, but what I'm now going to do, so the revenues and the expenses are going to be the same for the purposes of our taxable income. Now I'm going to be depreciating, I'm going to be including for tax purposes, depreciation of the $250,000 investment over the 5 years, so $50,000 each year. Now, for tax purposes, I don't include this estimated salvage value of $20,000. Now, the tax office doesn't like me making estimates, so it says what you should do is depreciate it over the period that we allow, and then if you end up selling it in that final year, we'll capture that and you'll pay tax on that $20,000. So the $20,000 goes into the assessable income, adding it to the $165,000 of revenue. So our assessable income each year is going to be the revenues, less the cash expenses, less the depreciation, and each year we're paying tax of 30% on that assessable income. So that gives us the amount of tax that we're paying, and that gets then reflected up in our NPV calculation. So again, we now get our net cash flows, taking into account the amount of tax that we're paying, multiply that by our present value factor, and that will give us the present value of the net cash flows. We add all of those up, and in this case we get 82,954. So we're still getting a positive NPV, so even taking into account tax, we would be accepting this project. So if we're going through our MPV, what we really want to incorporate is cash flows that will vary based on whether you undertake or don't undertake the decision. So these are what are called relevant cash flows. If you've already spent money and that won't change whether you proceed with the project or not, that's not relevant. That's what's called a sunk cost in economics. We don't take into account the costs of borrowing. That's a separate decision that the organisation will need to make. And we don't take into account sort of depreciation for accounting purposes. That is writing down the value of the asset over time. But we do, if we're modelling the tax effects, take into account depreciation for tax purposes. There's another illustration that I've got on the spreadsheet that I'll talk through in a separate video for you. In this case, what we're doing is we're also taking into account the investment of working capital. So what that means is that often if we undertake a project, we're going to have money tied up in the organisation. So we need to have extra inventory on hand, or we need to have extra accounts receivables going to be on hand. So one of the things that we're taking into account in this example is that if we undertake the proposal, it will estimate that we need an investment of working capital in $36,000. Now, working capital is usually considered current assets and current liabilities of a business. So that's things that we expect to use or pay in the next 12 months. So that's going to be things like inventory, it's going to be things like accounts receivable, also accounts payable, are all comprising working capital. But what will typically happen is that if we undertake a new project, it could be we've got increased inventory and receivables that we need. So to support a new project, a firm may need to build up inventory levels, work in process, finished goods, and this is going to tie up cash in inventory assets. But these are going to be realised by the end of the project. So what we'll be doing is modelling this as an outflow of $36,000 in the first year, and then an inflow of $36,000 in the final year. But this $36,000 wouldn't be taxed. Again, I'll show you in the next video how we can go through and see the MPV for this project. Related to the MPV is the internal rate of return. So the internal rate of return for a project is the discount rate that makes the MPV equal to zero. I'll say that again. It's the discount rate that makes the NPV equal to zero. Let's go back to our first example and see if we can see how this works. So with the discount rate of 10%, we had an NPV of 2,000. So if I increase this discount rate to 15%, MPV becomes 986. If I increase it to 20%, it becomes 47, so we're close. If I go to 21%, we're now negative. So it's somewhere in between 20 and 21%. So I could sort of trial and error to get close to what I thought. So 20.1. So it's somewhere close to 20.1. Let me go back to 10%. The internal rate of return, so is that rate of return that makes the MPV zero. So what we can see here is both Google Sheets and Excel, and I'll start afresh here. If we type in equal IRR, and then I'll give the cash flow amounts of 1,000, and here it just wants me to give a starting assessment because it does an iterative process. Let's just say 10% as the start. Then it's going to tell me that 20.27% is the discount rate that makes the NPV of this project equal to zero. So our decision rule, if we're using internal rate of return, is going to be if the internal rate of return is above our organisation's hurdle rate, then we'll accept the project, which is algebraically, that's exactly the same thing as saying if the NPV is above zero. So if the NPV is positive, then the IRR must be above the internal rate of return. And so that's the internal rate of return. As I said, the decision rule, you'll accept the project if the internal rate of return is above the hurdle rate. One thing to be aware of if you're sort of just looking at internal rates of return, when you start getting unusual patterns of cash flows, so positive net present or positive net cash flows followed by negative net cash flows, then you end up getting multiple solutions. So the model tends to break down a bit. If you're looking at projects over a different length, the internal rate of return calculation may not provide you with the same ranking as the MPV. As I said, the reason is popular because it gives us a rate of return that we can just compare to our organisation's internal hurdle rate. The final measure that we can look at is the payback period. And the payback period ignores the time value of money and simply takes into account how long does it take before we get our initial investment back. So it's going to be focusing on how fast the cash flows come back, not the overall value that a project is going to generate. Let's have a look and see if we can see how that's going to work. So if I'm trying to find the payback period, here the initial investment is 10,000. I've then got, so I'm going to be calculating here my cumulative cash flows. So $5,000. So I've now got a cumulative cash flow. So I'll just type here cumulative cash flow. In the next year, I'm now down to negative $1,000 because I've got the 5,000 plus the 4,000. And so in between year 2 and 3 is where I cross over. So depending on how precise we want to be, people will either say the payback period is 3 years, or they'll say it's going to be kind of 1/3 of the way through that third year, which is assuming the cash flows occur evenly throughout the year, in which case it'll be kind of 2.33 years. But typically we're going to say the payback period here is going to be 3 years. So it's after 3 years, I have recovered that initial $10,000 investment. So what's good about the payback period? Tells us very quickly how long it's going to take to get our money back. Some of the limitations of the payback period, it doesn't tell us about any cash flows that occur after that payback period has passed. So it ignores any, in our example there, any cash flows after year 3. And there's another kind of example that you can have a look at in the slides. So as I said, have a think about, for your organisation, what's going to be the appropriate discount rate, and who tells you this? And if you're managing a business, what should you be advising your employees to be using? This is particularly a concern about space-related projects because the risk of these projects, that is, the likelihood that you're going to get either highly variable or kind of a zero return, is a lot higher than a lot of terrestrial mining projects. So there's always a lot of debate about what the appropriate hurdle rate or what the appropriate discount rate is for space resource projects. Again, for payback period, what's going to be the acceptable payback period for an organisation? And again, that might be a function of what the capital providers are looking for. How quickly do they need their money back? So venture capital typically requires its money back faster than ordinary shareholders who make an investment at something like an IPO of an organisation. Other issues that we've got when we're focusing specifically on space resources is that it's inherently difficult to estimate what the future cash flows are going to be. So in that case, sensitivity analysis is going to become really important. So in other words, varying your assumed cash flows to see what happens if I'm being optimistic, what happens if I'm being pessimistic. Uh, It's also, I mentioned the difficulty in assessing a discount rate. It's also likely that the riskiness of your project might lower over time as technologies become bedded in and more reliable. And the way that people can do this is that you can use a time varying discount rate. So that is, you can have a high discount rate in early years of the project, and that can lower over time. Now, organisations tend to use a time constant discount rate, so a discount rate that doesn't vary, but you can model changes in that. So, what are our key takeaways? What we're trying to do here is work out what are some of the common, or address what are some of the common ways that organisations are going to assess their capital investment or capital budgeting decisions. We've got the MPV and IRR, both of which take into account time value of money. We've got payback period, which doesn't.